everyone, and welcome to the Momentum Lab channel. This week's video is about choosing the best momentum mutual fund that is available out there in the market for you. As all of you know, mutual funds are a very popular instrument, and most of us who cannot actively take out the time to invest in stocks do rely on mutual funds to do that for us. So without further ado, let's get into the video. Now, before getting into the video, I'd like to share a disclaimer that I'm not a SEBI registered advisor. Therefore, anything that I discuss in this video is only to be treated as educational content, and any financial decision that you would like to take with respect to mutual funds, stocks, momentum investing, value investing, etc., have to go through your own fund manager, a registered fund manager, and take an appropriate financial decision. Now, without further ado, let's get into the video. Our existing subscribers may know that we are doing a series on choosing your best momentum mutual funds every month. And this is a third such video for the month of July. For new subscribers over here, this video will discuss in detail about the steps that we would take if we were to invest in momentum-based mutual funds. So I will take you through all the steps that we take and also explain why a particular decision has been taken. Now, the first and foremost step for this is to identify what kind of mutual fund you want to invest in, right? So there are two types of momentum mutual funds. There are active momentum-based mutual funds, and there are also passive momentum-based mutual funds. Now, what is the difference between the two, and which one should I pick? So it's important for us to understand the difference between the both, and then try to take a call on which one is best suited. So what active mutual funds do are that, the fund managers usually pick a benchmark. It could be Nifty 50, it could be Nifty Next 50, it could be Sensex 30, etc. And the portfolio manager tries to beat the returns of these benchmarks. So simply to understand that an active momentum-based mutual fund tries to beat the existing benchmarks and returns of the benchmarks, right? So they're trying to do better than what a benchmark return does. Now, on the same line, passive mutual funds, what they do is they are trying to give you the exact returns of the benchmarks, right? So whatever their benchmark might be, again, it could be Nifty 200, it could be Nifty 50, it could be any of the benchmark, and whatever returns the benchmark or the index does, a passive momentum mutual fund manager will try to replicate the exact returns. No more returns, no less returns. They will try and replicate the exact returns. So these are the two kinds of momentum-based mutual funds we have. So at the first glance, we might easily think that, this is a no-brainer. I will absolutely pick an active momentum mutual fund because naturally they're trying to beat the returns. That may be so. But a more important question that we might ask, or we should ask, is, are the active mutual funds really beating their, benchmark returns? Are they meeting the objective? I think that will be an interesting question. So there is a study that also exists for this. Let me take you through the study. So S&P Global has been conducting a study to see if, how the mutual funds are performing, etc. And India is also a part of the study. So there is this detailed report, which again, I will be linking in the description of this video for your perusal. Now, just for a quick understanding and to give you a quick snapshot to answer the question of if active mutual funds are actually meeting their objective and beating the benchmark returns of the indices that they choose or not, let us take a look at this graph. Now, in this graph, let us consider, the large cap and equity components of large cap and mid small cap. And what this chart is showing is how many of the active mutual funds, Indian active mutual funds, are underperforming. So they are not showing how many are performing or meeting their objective. Instead, they're showing how many are underperforming and not meeting their objective. So simply put, larger this number, it means that larger number of active mutual funds in India are not meeting their objective. So you will see that in the equity large cap section, around 80 to 90, above 85% are not meeting their objective of beating the benchmark returns. You might also ask that, why are you not considering 1 year over here? Why are you looking at the 3 years returns? So we have been discussing in our videos, in several videos, that, a return that you generate on 1 year, either be it mutual fund, small case, ETF, etc., are maybe luck-based returns, right? So what I mean is that perhaps that year was good, or, perhaps that year was bad. So the range of what you actually get in a 1 year period is really large. So you may get very low returns, or you may get very high returns. So considering that kind of non-stability, we usually do not consider any 1 year returns in any of the study or analysis that we conduct. So going with the same principle of using 3 years for understanding exact returns or stabilized returns of the mutual funds, I'll be considering 3 years here as well. So for the large cap sector, as you see that 85%, around 85% are not performing or are underperforming their objectives. And if you take the mid small cap space, it is around about 60%. So I can easily say that overall there is 70% of active mutual funds on an average, depending on the size of them, do not meet their objective. So however great the objective might be of giving higher than benchmark returns, since these mutual funds are not meeting their objectives, it would be prudent of us to sort of go and look at what are the alternatives that are available, right? So the alternative that is available to us is passive mutual fund. And what do passive mutual funds do? Passive mutual funds simply try to replicate the index. So the same components exactly as the index has. So they try to replicate the components and therefore try to replicate the returns. So given this comparison, I think it is fair to say that passive momentum mutual funds are a better bet when we look at the performance of active momentum mutual funds. There is another reason why passive momentum mutual funds or passive mutual funds may be a better option than the active mutual funds, and it is to do something with the cost. So to run an active fund, you need a huge team, you need a lot of research tools. The costs surrounding running an active mutual fund are high. The second thing is that you also actively transact many times in an active mutual fund, which means that you're buying and selling at regular intervals, and there is sufficient transaction cost that is associated with this. So the first thing was that we have a high, a large research team or tools, etc., and that cost coming into an actual mutual fund. The second thing is that there are also active buying and selling, therefore transaction costs that are going to be associated. Now, on the other hand, in a passive momentum mutual fund or in a passive mutual fund, we are simply trying to replicate the returns of an index. So the index is already defined by NSE. So NSE already gives you the components of a particular index constituent, what we call as an index constituent. So NSE already provides you this index constituent, and what the mutual fund manager has to do is that they simply have to replicate the same constituents, and rebalancing in a passive mutual fund happens every 6 months. So you're doing it twice a year, the rebalance happens twice a year, and you're not consistently or actively buying or selling stocks as a part of your mutual fund. So considering all of this and the cost structures, I think in a passive mutual fund, what happens is you are getting benchmark returns or similar to benchmark returns at lower costs. And in active mutual funds, your costs are also high. And what the study that we just used shows is that most of the times, these mutual funds are also not meeting their objectives. So considering these two aspects, it is fair to say that if I were to choose a kind of a mutual fund, I am definitely going to go for the passive momentum mutual funds. Now, nevertheless, let me just show you what are the active momentum-based mutual funds that are available to us. Two fund houses are offering this to us, Quant and Sampo. And there is not much of data available to us at the moment because some of them have been, both of them have been launched very recently. We may have data for Sampo, but since we are not digging deep into the active momentum mutual fund space at the point, I am just leaving the data at this. So we have expense ratio somewhere around 1% for both the funds. With Quant having slightly less expense ratios, but these are the two active momentum-based mutual funds that are available to us in the market. Now let us go and look at the passive momentum mutual fund space. So there are before we dig into the exact mutual, fund houses or the exact mutual funds, we also have to understand what are the existing indices, and what do they cover, how are they performing, etc., and which is a good sort of a index to select and then look at a mutual fund, right? So let's do just that. Over here, we have a list of 5 indices: Nifty 200 Momentum 30, Nifty Mid Cap 150 Momentum 50, Nifty Small Cap 250 Momentum Quality 100, Nifty 500 Momentum 50, and Nifty Mid Small Cap 400 Momentum Quality 100. So these are the indices that are defined by NSE. If you go to the niftyindices.com page, you will be able to find several indices, and you can look at other mutual funds also in general if you're picking them. But for the sake of this video and for the sake of just momentum based mutual funds, I'm going to be looking at these indices which focus only on momentum. Now, if you can also go ahead and look, have a detailed look at the fact sheets, you can look at the index constituent, the methodology in which this particular index has been framed, etc. What you have to do is simply click on the drop down, and you have several lists of this. You have to go and select what are included in the momentum list, right? So So now that we have established that there are five indices, momentum-based indices that are available to us, how do we then choose, which mutual fund is better for us? So before we go to a specific mutual fund that is, good for us, it's easier in passive momentum mutual funds to choose a mutual fund because we simply have to compare the indices. So because the passive momentum mutual funds are only trying to replicate the returns, if we understand which of these indices provides us good returns or which one is providing the better returns, then we simply choose that category of index, and then in that you can choose a mutual fund, right? So how do we do this? How do I understand which index is doing better? We don't have to do a lot of work for that as well. Like I showed you this page, which speaks about the index methodology, index constituents, etc. It also provides us something called as a fact sheet. Now, what this fact sheet does is it is regularly updated, and the fact sheet speaks about important indicators. So we have index returns, we have quarter to date, then we have year to date, we have 1 year, 5 years, and since inception. So you can see that, this particular index was launched only on February 8th, 2024. But then how do they have, how do they have base data, etc.? So NSE holds a lot of data, and there's a lot of backtesting that is done, and results are provided to us in such a manner because NSE holds a lot of data. Now, coming to the facts of this, we also have other important statistics such as standard deviation. Again, it's provided to you for different years and different time spans. Now, how are these two useful for us? So if you remember that we had discussed something called a Sharpe ratio in the small cases video, and Sharpe ratio is nothing but returns by risk, and risk is how do we define risk? Risk is defined as the standard deviation. Now, considering that, we can understand which of these funds is giving us which of this is having a better Sharpe ratio. So what we have defined in the small cases video is also that if a Sharpe ratio is more than 1, if it's above 1, then it's a good case scenario because we are getting almost the same kind of returns for the risk that we put in. And anything that is less than 1, you have more risk to the return that you're getting. Now, considering all of this data, we can understand that which particular index is performing better, and then therefore pick that index, and then we can also pick mutual funds that fall under that index. I have put all of the data over here in a Google Sheet for you, and let me try to take you through the data with the help of this chart. So over here, we have a risk-reward comparison of the indices so that we are able to easily identify, which index to choose. So we have also looked at something called the Sharpe ratio in our small case videos, and anything that has a Sharpe ratio more than 1 looks beneficial for us because the risk to reward looks equal. Now, on the x-axis of this chart, we have the risk or standard deviation. So the further you go away on the chart, or further you go to the right, you have more risk. And on the y-axis, we have annualized returns since 2005. And the farther you go up, you will see that the returns are higher. So the ideal case scenario is that we need something that is very low on risk and very high on returns, right? So something which is close here is a good space. So the first and foremost in terms of returns, if you look in terms of returns, the highest returns is being offered by Nifty Midcap 50 Momentum, Nifty Midcap 150 Momentum 50 Index, but it has a little bit of more risk. If you look at it, it's somewhere in the middle. Now, Nifty Mid Small Cap 400 Momentum Quality 100 has very low risk of all the 5 indices that are available here to us. But in terms of returns, in comparison to Nifty Midcap 150 Momentum 50, the returns are slightly lower. Now, these two seem to be the best case scenarios for us, and we can also plot that using, we can also identify that using Sharpe ratios. Now, let me take you through a detailed table, which I have prepared again for our easy understanding. This table showcases the index that is there, the annualized return, standard deviation, and Sharpe ratios. Now, a simple glance will tell us that, based on the Sharpe ratio, that there are 2 indices which have a Sharpe ratio of more than 1, which is Nifty Mid Small Cap 400 Momentum Quality and Nifty Midcap 150 Momentum 50. There is also a study which has been conducted by Rajan Raju and others. I will be linking that in the description here for you, again, to understand easily, or go through the paper if you're interested in. What it says is essentially is that the mid-small cap space is a really good space to be in if you're looking at returns. So this table is also saying the same thing almost, because the mid-cap 150 space and the mid-small cap 400 space are looking like, they have better returns and also have better Sharpe ratios in comparison. Now, if you look at the small cap 250, it also has good returns. And Nifty 500, which comprises of a large part of these mid and small cap, also has nice returns. But when we compare Sharpe ratios and look at that, we will understand that both Nifty Midcap 150 Momentum 50, this one, the second one, and the last one, Mid Small Cap 400 Momentum Quality, are doing considerably better. The chart that the scatter plot that we saw just right before also says that also says the same thing. It says that these two are looking good for us. Now, considering the funds that are available to us in the market, let me take you through this Nifty Mid Small Cap 400 Momentum Quality 100. If I just look at what are the funds that are being offered, etc., we will see that there are particularly no active mutual funds that are being offered. There is an ETF that is listed by Mirae Asset, but there are other mutual funds are also coming in, and they're at NFO stages. Another thing that you can do now that I'm on this page is that you simply can go to this page and look at what are the different mutual fund domestic index funds that are being offered, right? So in case you want to do this analysis at a later date, or you want to do this analysis for different kinds of mutual funds which you want to invest in, you can also go to that particular index and go down, scroll down a little bit and find out who is the issuer, what are the different kinds of domestic index funds that are available. So now that we have established that, Nifty Mid Cap 150 Momentum 50 and Nifty Mid Small Cap 400 Momentum Quality 100 indices are doing better. In fact, they are doing the best of everything available. We will see what are the different mutual funds that are being offered in this space. Like I said before, the Nifty Mid Small Cap 400 Momentum Quality 100 just has an ETF in offering. It does not have a mutual fund in offering at the moment. So we will not be able to consider this. And we will simply skip on to the Nifty Mid Cap 150 Momentum 50. So again, there are two funds that are being offered by two different fund houses. There is Tata and there is also Edelweiss. Now, we also have to take a call over here. So how do I take this call? It's a little difficult, isn't it? Or how do I choose it? What are the different parameters that I need to have? Because so far what we have done is we have methodically sort of tried to eliminate either the kind of mutual fund or the category of mutual fund or the index, etc. So even over here, when we have to choose one of the two, we have to categorically and methodically choose. So what are a few different things or a few different parameters that we will be able to we have, which we can use to compare and understand which is the better mutual fund? There are two parameters. One is the expense ratio and one is the tracking difference error. So let me tell you what this tracking difference error is. So when the passive mutual fund, momentum mutual fund manager is trying to replicate, or the particular mutual fund is trying to replicate the index, what happens is that the prices at which the mutual fund may buy or sell are very different than the prices which the index itself considers while calculating the returns. As you know that stocks keep getting volatile on a daily basis, on a minute basis, on a seconds basis, right? So these sort of transactions, when they occur, there is going to be price difference. And all of these price differences, if you take the amount of money and you have invested and the number of transactions, etc. So over time, there is going to be a slight difference in the kind of returns that the benchmark will have and the kind of returns that the mutual fund will have. So tracking difference error is nothing but the difference between the returns that the mutual fund has made in comparison to the returns that the benchmark had made, the index has made, right? So how do you calculate this? Ideally, what happens is that this is an Edelweiss Nifty Midcap 150 Momentum 50 Index Fund fact sheet. So if you go to the mutual fund website and you also look at the particular details of the mutual fund that is an offering, there is again another fact sheet that is available to us like this. So you can get latest data, and this is as on 28 June 2024. So when you look at such fact sheets, what you will understand is you will be given the total expense ratios. So you can take the numbers directly from here, and to calculate the tracking difference error, we will have something. There is a fund performance table that will be listed in for all the funds, and this is the fund's performance for 1 year, and this is the benchmark performance. So what you can simply do is you can subtract the fund performance returns from the benchmark returns to understand what the tracking difference error is. Ideally, what happens is that each and every fund has to provide what the tracking difference error for 1 year is. But in some funds, it's difficult to find, or in some funds, it's not readily available in the fact sheets or websites as well. So just to keep a uniformity, what we have done is we have taken the benchmark returns for 1 year and we have subtracted the returns of the particular mutual fund in 1 year to get this tracking difference error. Now, so tracking difference error also, what it simply tells you is that it will tell you how close the returns are to the benchmark index. So smaller the error, closer it is to the benchmark returns. So simply to understand that lesser the error, it is closer to the benchmark returns. Now, if we compare Tata and Edelweiss, we can see that if we compare the expense ratios, Edelweiss is good. And if we also look at the tracking difference error for 1 year, even in that aspect, we are having Edelweiss Nifty Midcap 150 Momentum 50 Fund has a tracking difference of 2.28. So considering all of these aspects, Edelweiss Nifty Midcap 150 Momentum 50 at this month, at this date where we have conducted the analysis, looks like the best momentum-based mutual fund, passive mutual fund that you can choose. Now, let us also see what are the different kinds of funds that are available in other indices. If you go to the Nifty Small Cap 250 Momentum Quality space, you only have one fund. Again, it's a very new fund. It's been launched on 4th March 2024. So, though we have an expense ratio, we do not really have a tracking difference error. Tracking difference error usually we calculate for 1 year as a standardized unit. So, because we don't have, the fund hasn't run for 1 year so far, we don't have that value. Now, let me also show you what are the different types of funds that are available in Nifty 200 Momentum 30. There is 6 fund houses offering it. There's Kotak, HDFC, Motilal Oswal, ICICI, UTI, and Bandhan. Now, over here as well, I think the expense ratios are somewhat similar, except for ICICI, where the expense ratio is around 0.3%. But for everything else, it's around 0.4% or in between 0.4 to 5%. So expense ratios are pretty similar. And in tracking difference errors, again, for HDFC, the tracking difference error doesn't play a part here because it's been running for less than 1 year. For Kotak, Motilal Oswal, ICICI, UTI, and Bandhan, you can compare. So UTI has the least tracking difference, which means that it is giving you as much returns as the benchmark with just 1.16% difference. So these are the different mutual funds that are being offered in the momentum space. And you can also use this particular step-by-step analysis if you want to compare any other mutual fund for educational purposes. So that's it for this video, for this week's video. Thanks again for joining with us, and see you soon.